If you are a doctor making over $300,000 a year, there is a very good chance you overpaid the IRS by $30,000 to $50,000, even more last year. Not because you did anything wrong, because nobody showed you the legal moves the wealthy use every single day. Stay with me for the next few minutes and I'll show you 6 of them. The last one isn't even about saving taxes. It's about building a legacy. Let's go. I am Noura a tax advisor, and I help business owners stop overpaying in taxes. And physicians are the people who overpay the most. With promise, no fluff, no jargon you need a CPA to translate, just the strategies, the 2026 numbers, and exactly who each one is for. Take notes and then take this list to your own tax accountant. Number 1 is the one most doctor gets wrong from day one. If you own your practice, your business structure is the biggest leverage you've got, and most physicians never pull it. Here's the problem. As a sole proprietor or single member LLC, every dollar of profit gets hit with self-employment tax on top of income tax. That's money walking out the door. Now, watch what an S corporation does. It splits your income into a reasonable salary, tax for payroll, and the rest as profit distributions, which skip the Social Security and Medicare tax entirely. For a high-earning practice, that's thousands back in your pockets every single year. For you, one catch: the IRS wants that salary to be reasonable for your specialty. Too low, and you've got yourself an audit. This is a do it with your tax accountant move, not a guess. Next one is small, but it's the most tax efficient account that exists: the health saving account. If you are on a qualifying high deductible plan, the HSA does something nothing else does: a triple tax advantage. Deductible going in, grows tax-free, comes out tax-free for medical costs. $4,400 if it's just you, $8,750 for a family, plus another $1,000 if you are 55 or older. And here's the move: almost no one makes. Don't spend it. Pay your medical bills out of pocket. Let the HSA invest and compound for 20, 30 years, and you've built a tax-free fortune for healthcare in retirement. After 65, you can use it for anything. Strategy number 3. You've probably heard about the 20% QPI deduction, and the 2025 tax law just made it permanent. Sounds great. Here's the trap. Healthcare is what the IRS calls a specified service business. Above a certain income, that 20% vanishes completely. For 2026, merit filing jointly, it starts phasing out around $403,500 and is gone by about $553 and $500. Most full-time attendings already over the line. So why bring it up? 2 reasons. If you are early career or part-time and under those numbers, you may still get the full deduction. And if you build income outside medicine, real estate, and equipment rental company in its own entity, that income does not hit the healthcare cliff. Structure it right, and you keep what others lose. Strategy number 4. This is one of my favorites, and it's hiding inside your own house. It's called the Augusta Rule. You can rent your home to your own business for up to 14 days a year, and that rental income is 100% tax-free to you. At the same time, your business gets to deduct every dollar it pays you. Quarterly planning meeting, team trainings, strategy retreats, host them at your home, have the business pay you a fair market rate, and you've moved money from your business to your personal accounts. Tax free. But play it straight. Real business purpose, a reasonable rate, what a comparable venue would charge, and documents everything. Purpose, date, invoice, payment, done right. It's bulletproof. Sloppy, and it falls apart. If you are interested to learn more about Augusta role, watch this video where I explain it more. Strategy 5. Put your kids on payroll and pay them tax-free. Got kids and a business? This one builds wealth in 2 generations. Hire them for real age-appropriate work. Filing, scanning your social media, cleaning the office. Pay a reasonable wage, and the wage becomes a deduction for you. You just shifted income out of your bracket and into theirs. Here's the kicker. In 2026, the standard deduction is $16,100. So your child can earn up to that and pay 0 federal income tax on it. And if your business is a sole proprietor or a partnership owned only by you and your spouse, wages to a child under 18 also skip Social Security and Medicare tax. Important? That payroll break does not apply if your practice is an S Corp. So line this up with how you are structured. You just give them a tax-free retirement account before they can drive. If you want to learn more about how to hire your kids and protect yourself, watch this video. The last one is for when you've made it, when the question shifts from how do I save on taxes to what do I want my money to stand for? A private family foundation turns your giving into a lasting engine for impact. And the tax benefits are real. Cash gift deduct up to 30% of your income. Appreciated stock up to 20%. And carry forward anything unused for 5 years. Give appreciated stock instead of cash and you dodge the capital gain tax too. Inside the foundation, your money grows paying just a small excise tax, 1.39% for most. And only a foundation lets you put your family on the mission and pass your values down for generations. The honest part, it's a commitment. You must give away about 5% of assets every year. File a public return and follow strict self-dealing rules. So for many people, a simpler donor advised fund is the smart first step. But when you are ready to give at scale with intention, this is how the wealthy do it. If you want to learn more about private foundation, you can watch this video next. So here's what I need you to hear. Your tax bill is not a number the IRS hands you. It's the result of decisions. Your entity, your account, your home, your family, and your legacy. You spent a decade mastering medicine. Your money deserves that same level of strategy. So don't guess and don't wait for tax season. Book your tax analysis strategy session now. We'll look at your full picture together and find the money you've been leaving on the table.